Amid a massive withdrawal of foreign capital and a bleak economic outlook for China, Moody's, a global renowned credit rating agency, has taken a pessimistic stance on the country. Between December 5th and 7th, Moody's downgraded the sovereign credit outlook of China, Hong Kong, and Macau from stable to negative. Additionally, Moody's also downgraded the outlooks of several Chinese financial institutions, insurance companies, state-owned enterprises, and municipal infrastructure companies. This comprehensive downgrade of credit ratings from the government level to enterprises and finance sectors by Moody's can be seen as a warning bell for an impending economic crisis in China. The downgrade by Moody's was not of the ratings themselves, but of the outlooks, indicating a forecast of future ratings. This marks the first time in over 7 years that Moody's has downgraded China's sovereign credit outlook. As one of the world's 3 most authoritative rating agencies, Moody's ratings significantly impact global markets. Analysts believe that Moody's recent downgrade of China's sovereign credit outlook will primarily affect 2 areas. 1. It will diminish the confidence of other countries and international capital in investing in China, leading to an accelerated withdrawal of international capital. 2. Since sovereign credit ratings act as a rating ceiling for enterprises, a downgrade will reduce these companies' borrowing capabilities in international credit markets and increase their borrowing costs. Thus, Moody's rating outcome is a significant blow to the already debt-ridden Chinese government, undermining its efforts to boost economic recovery through international financing and attracting foreign investments. In a statement released on December 5th, Moody's explained the downgrade by indicating that increasing evidence suggests Chinese authorities will have to support heavily indebted local governments and state-owned enterprises, potentially risking China's fiscal, economic, and institutional strength. Additionally, Moody's cited concerns about the unpredictability of the Chinese government's tools and commitments to supporting private enterprises, with regulatory changes in internet platforms and the education sector serving as examples. Interestingly, just hours before the release of Moody's rating decision, the Chinese stock market experienced a significant drop, leading to reports that Moody's rating decision had been leaked beforehand. Moody's seemingly avoided the Chinese stock trading hours, releasing the rating announcement at 3:25 p.m. Beijing time on December 5th. After the close of the Chinese stock market at 3 p.m. However, the Chinese stock market had already begun accelerating its sell-off right after opening at 1 p.m. that day. The 3 major A-share indices all fell, with the Shanghai Composite Index losing the 3,000-point mark for the first time in 1.5 months. By the end of the day, the Shanghai Composite Index fell by 1.67% to 2,972 points. The Shenzhen Component Index by 1.97% down to 9,470 points, and the Chinext Index by 1.98% to 1,871 points. Chinese blue-chip stocks even fell to a near 5-year low. Additionally, the net outflow of northbound funds, representing foreign investments, amounted to 7.5 billion yuan, indicating a complete loss of market confidence in China's economic growth. According to Reuters and Bloomberg, the news of Moody's downgrade was already circulating on social media several hours before the announcement. At 10:51 a.m. on the day of the announcement, a post containing the decision and its release time was circulated on WeChat, which was later deleted but preserved by traders. Insiders revealed that some investors began speculating about a possible downgrade as early as December 1st in private chat rooms, suggesting that at least some people had prior knowledge of the news. A person familiar with the process stated that rating agencies typically assess sovereign ratings through a committee and usually notify the relevant government a few days in advance before making a public announcement. The decision often involves analysts from around the world. Moody's and China's Ministry of Finance did not immediately respond to requests for comment regarding the leak of Moody's decision. However, Chinese authorities quickly responded to Moody's rating result. On December 5th, China's Ministry of Finance expressed disappointment with the decision, claiming that the Chinese economy will have strong resilience and tremendous potential, The ministry argued that Moody's concerns about China's economic growth prospects and fiscal sustainability were unnecessary, implying that Moody's downgrading of China's sovereign credit rating was a misjudgment. On December 6, China's Ministry of Foreign Affairs also responded, stating, "The fundamental aspects of China's long-term positive economic growth have not and will not change. We have the confidence and ability to achieve long-term stable development." Moody's concerns about China's economic growth prospects and fiscal sustainability are unnecessary. Subsequently, Chinese state media outlets, acting as mouthpieces for the government, launched a fierce attack on Moody's. A social media outlet operating under the Central Television published an article on December 6, criticizing Moody's downgrade of China's sovereign debt outlook as based on several misjudgments. The article claimed to have analyzed social media comments on the event using big data methods, finding that discussions focused on the significance of Moody's rating for China and the credibility of Moody's. However, such rebuttals are meaningless to the international community and only serve to soothe the wounded patriotism of Chinese nationalists. The article identified three major misjudgments in Moody's decision. First, it was criticism of Moody's, S&P, and Fitch, the three major international rating agencies, for being overly harsh on emerging market countries, often giving them lower credit ratings. The article also questioned the professionalism of agencies like Moody's, advising them to remove their biased glasses against emerging economies to make more objective, precise, and professional judgments. Second was criticizing Moody's for underestimating China's economic growth speed in 2024 and being overly pessimistic in its judgment of China's medium and long-term economic growth potential. The article mentioned that China's GDP grew by 5.2% year-over-year in the first 3 quarters of the year, leading among major global economies. However, as previously analyzed in other reports, China's National Bureau of Statistics is known for severe data falsification, and China's actual GDP growth this year not only failed to reach the expected 5%, but is also likely negative. The article also pointed out that from January to September, foreign investors established over 37,800 new foreign-funded enterprises in China, a year-over-year increase of 32%. However, it failed to mention that, according to data released by China's State Administration of Foreign Exchange, China's foreign direct investment outflow exceeded inflow for the first time in the third quarter of this year, was a net outflow of $11.8 billion, the first negative value since 1998. The investments being withdrawn and reduced exceeded new investments for factory construction and other purposes. The article also mentioned the strengthening of technological innovation capabilities of Chinese private enterprises as a potential driver of China's economic development. However, it neglected the Chinese authorities' crackdown on tech giants in recent years. Jack Ma, the founder of Alibaba, a leading tech company, has been out of the public eye for over 2 years, and numerous internet giants and CEOs have all resorted to large donations and retreats to ensure their safety. Furthermore, the State Advances Private Retreats policy is still in place, creating an extremely unfriendly environment for private enterprises in China and sapping their development momentum. The third major misjudgment the article accused Moody's of was overestimating the Chinese government's debt pressure, essentially questioning the effectiveness of China's policies. Let's take a closer look at the current state of China's local government debt, which is one of the main reasons Moody's mentioned for the downgrade. So, did Moody's overestimate the Chinese government's debt pressure? Due to the Chinese government's consistent data falsification, it is challenging to obtain accurate figures on the scale of China's local government debt. According to data from China's Ministry of Finance, as of the end of October 2023, the total local government debt balance in China was about 40 trillion yuan. However, in August, according to a report by the Central News Agency citing Goldman Sachs, China's local government debt accumulated to as high as 94 trillion yuan, including debts from local government financing platforms, which are off-balance sheet liabilities. The report pointed out that the State Council sent teams to more than 10 provinces with the worst finances to audit accounts, including off-balance sheet debts, and to find ways to reduce debt. For years, a significant portion of local government revenue in China has come from land sales, sustaining government operations. However, since last year, with the continued downturn in the real estate market, local government's land sale revenues have sharply declined. Data shows that land sale revenue decreased by 23.3% last year, with a further reduction of 19.8% in the first 3 quarters of this year. The decrease in land sale revenue has led local governments into a severe state of fiscal imbalance. Even considering central government transfers, local governments are facing a substantial and rapidly widening financial gap. This means that local governments not only lack surplus funds to pay off debts, but also continue to incur new debts to bridge these gaps. A financial blogger known for data analysis, Lao Man, posted that the absolute shortfall in local government finances was 1.5 trillion yuan in 2016, which rose to 5.7 trillion yuan by 2022. In just 6 years, this gap has expanded 2.8 times. The pandemic partly fueled this, but even with the lifting of COVID-19 restrictions this year, local government finances have not improved. In the first 3 quarters of this year, the fiscal shortfall reached 3.6 trillion yuan, with the annual deficit possibly reaching as high as 5 trillion yuan. The only solution to this gap is to issue new local government bonds. Furthermore, Lauman's analysis estimates that debt repayment pressure on local governments in 2023 amounts to 5.1 trillion yuan. This too requires issuing new refinancing bonds, essentially borrowing new ones to repay old debts. Combining these two factors means that local government bond issuance in 2023 must reach around 10 trillion yuan to ensure economic stability and prevent widespread default on local government debts. Thus, the so-called debt resolution work by the Chinese government is merely a continuous cycle of borrowing new to repay old debts. Regarding actual bond issuance, the latest data from China shows that by the end of November, the cumulative annual issuance of local government bonds had reached 9.14 trillion yuan, significantly surpassing the total annual issuance of 7.37 trillion yuan in 2022. Compared to local government bonds, urban investment bonds issued by local government financing platforms are even more concerning. Often not directly reflected in government financial statements, these debts are considered hidden liabilities of local governments and are seen as a black hole in China's financial system. The Wall Street Journal reports that after years of unrestrained borrowing and spending, provinces and cities in China have accumulated massive amounts of hidden debt, now reaching a critical point. The International Monetary Fund and Wall Street banks estimate that the total amount of outstanding off-balance sheet government debt is between 7 to 11 trillion US dollars, including corporate bonds issued by thousands of so-called local government financing platforms. While China's local government bonds are issued under strict and standardized management with funds used for designated purposes, the management of urban investment bonds issued by financing platforms is chaotically beyond imagination. With various issuance channels and diverse debt maturities and payment methods, urban investment bonds have traditionally relied on land sale revenues for principal and interest payments. However, the reduction in these revenues means that local governments now need to issue new bonds just to pay the interest on these debts. Data shows that from January to November this year, the cumulative issuance of urban investment bonds reached 5.24 trillion yuan, with the annual issuance expected to be 5.7 trillion yuan. Combined with the 10 trillion yuan of local government bonds, local government debt will extract over 15 trillion yuan from the financial market in just 1 year. To address the debt issue, local governments accelerated bond issuance from October. Data indicates that local government bonds and urban investment bonds issued in October amounted to 1.8 trillion yuan, a historic high. It's reported that all banks, insurance companies, security firms, and trust companies capable of being financial sponsors received mandatory requests to purchase local government bonds. This was part of the top priority debt resolution work, aimed at resolving the local government debt crisis. In November, the combined issuance of local government bonds and urban investment bonds reached another 961 billion yuan. Based on this data, the issuance scale of local government bonds and urban investment bonds in December is estimated to reach a trillion yuan level. However, this is still far from sufficient, as both local and central government need funds. With the central government also lacking funds, it has no choice but to issue bonds and borrow money. Data shows that from January to November this year, the issuance of national bonds has already reached nearly 10 trillion yuan, with the total for the year expected to exceed 11 trillion yuan. Lauman concludes from his analysis that China's national and local government bonds are withdrawing 1 trillion yuan from the financial market every month. Most of these funds are used for rolling over various debts. This will completely drain the financial market's liquidity, leaving no opportunity for the stock market. This is one of the reasons why the Chinese stock market has been hovering around 3,000 points in recent years. As local government debt continues to accumulate aggressively, this financial drain from the market will persist. Funds cannot return to the hands of ordinary people or flow into the real economy. They must circulate endlessly between the government and financial institutions. The government borrows money through bond issuance, only to repay it to financial institutions. Financial institutions, in turn, cannot allow depositors to take the money for investment and consumption. They must pool these funds to face the next government bond issuance. This crazy circulation of funds, a game of borrowing and repaying debts, cannot stop for even a second. A pause would lead to the collapse of the entire chain, with the government and banks queuing up for bankruptcy. This is the current state of China's debt crisis. The most alarming aspect is the scale of repayments of both local and urban investment bonds. Starting from 2024, the repayment will enter a nightmarish amount, reaching 12 trillion yuan. This intense debt repayment pressure will continue every year until 2030. Rising to 18 trillion yuan. Local governments will not have the funds to meet this repayment, nor will the financial system have the liquidity to support it, making it difficult to sustain this game of borrowing new to repay old debts. To resolve this issue, other than the central bank printing money and driving up inflation to support local governments in addressing their urban investment bond issues, there are no other viable options. However, if the central bank prints more than 10 trillion yuan of base money each year to help local governments repay debts, the outcome will be the devaluation of the yuan to worthlessness. Based on Lauman's data model, the death knell for local government bonds will either ring within the next 3 years, by 2025, or if they manage to survive through money printing, the absolute limit will be 2030. Therefore, from this data analysis, Moody's assessment of China's sovereign credit rating is not a misjudgment, but is based on solid data. Perhaps as early as 2024, China's local government debt will trigger a debt storm. We may witness numerous financial institutions going bankrupt overnight, and countless families losing their hard-earned wealth, which will also have a significant impact on the global economy. The only thing the international community can do now is to withdraw investments from China as quickly as possible to minimize risks.